Hi, this is Connie Saunders with the Foreclosure Freedom Network show. I'm a licensed California realtor and a certified loss mitigation consultant and have been in the mortgages industry for 20 years. Today's show is on Hope for Homeowners. This is a failed program, first approved by Congress for action October 1st of 2008. Though they initially projected 400,000 applicants, only one person actually got approved, and the loan actually issued. The wheels simply never got greased for this program, largely because it was voluntary on the lender's part, and most lenders wanted to hold out for better assistance. With the new Home Affordable Stimulus Plan, HASP, and Home Affordability Modification Plan, HMP, both issued in March and April of this year, Obama and Congress have added emphasis on the Hope for Homeowners plan. In fact, now servicers offering the new HMP must explore Hope for Homeowners qualifications for all who are accepted for these loan modifications. So what's the Hope for Homeowners program anyway? Homeowners who will greatly benefit from this are ones who plan to live in the home for at least 5 or more years and whose property value has fallen exponentially down from the time the note was refinanced to current. In this program, the bet would be to move after the point that the home prices went up higher than the 2006 peak in the bubble. Or there is a risk that some of this share equity could mount up to a bit of a negative over what one could have made if you had simply defaulted and foreclosed on this one and got a new home later. Homeowners who are saved from foreclosure today and want to continue in their home will be benefited regardless of this ultimate negative, because 50% of nothing is still nothing, but 50% of future appreciation in your home means that your family can continue to live in your home for as long as you choose, and you don't have to pay interest and principal on a much higher amount. The bigger the differential in the current value to the prior value that you had on this loan at the peak, the bigger the value this program is to the homeowner. Most other lender modifications will bundle up the principal forgiven balance and put it in a balloon note at the end of the loan, but it's still going to be due. In the H4H loan, this principal is forgiven conditionally, with a key condition being that the homeowner has to share the equity with the government once there is equity. And the government reimburses both primary and subordinate lien holders with that appreciation in the end. So even after that, when this loan is completely paid off, this appreciation is still going to be shared. Assuming that the homeowner wants to stay in the home and agrees to the terms of equity sharing for future appreciation, I'll tell you now the details of how to apply and what the program consists of. There's 4 avenues to apply. Number 1, you could contact your existing lender or any lender to discuss or find out if you qualify. You can look on the FHA or HUD site to see if what their approved list is of FHA vendors as well, to see who you can apply for this loan with. If you're looking, for instance, as a lender and looking for solutions for your portfolio, you can suggest this to people. Or if you're a lender and you want to work with servicers' portfolios to assist troubled homeowners, you can use this. Or counselors like us who are working with troubled homeowners may refer people to this solution, and particularly if it's mutually agreeable, to prevent foreclosure. Keep in mind that FHA does have to be the underwriter, since this is an FHA loan. And if a lender isn't FHA qualified, they may need to hire an outside firm to do this. Lenders are now required, as part of their fiduciary responsibility, to assess their portfolio and perform a cost-to-benefit analysis to determine the feasibility of offering this program to struggling homeowners. 1. Lenders will take, this is the program in its working. 1. Lenders will take the loss of the difference between the existing obligations and the new loan. The new note amount will be set at 96.5% of the current appraised value of the home. A lender may choose to provide the homeowners with an affordable monthly mortgage payment through a loan modification of their own rather than accepting the losses of principal balance associated with this. 2, for a borrower to be eligible, his loan has to have been originated before 1 January of 2008. 2, existing mortgage payments do need to exceed 31% of the borrower's monthly gross income. 3, the homeowner can't have intentionally defaulted, and 4, the homeowner can't have been convicted of fraud or dishonest in his loan application, and also he can't have provided false information on this new loan or the earlier loan. 3, the new mortgage will be based on 96.5% of the value of the loan and therefore create a much more viable situation for the homeowner. 4, the homeowner and the government will share the equity at 50% or greater when the home is sold, if it's greater than 5 years after the purchase. If it's less than 5 years after the purchase or after this refinance, then he shares a lesser percentage with the government, getting up to 100% of the appreciation. So there will be prohibitions also against new junior liens on the property unless they're directly related to property maintenance. 6, there are upfront fees that must be paid or they'll be added onto the loan, such as 3% insurance premium, and that will more or less wipe out the equity increase initially that's being advertised in this. So it's a little bit misleading there. 7, the homeowner must sign that they didn't intentionally default, meaning they didn't have any readily available funds at the time that the payment on the mortgage debt was due that could have paid the mortgage or other debt without undue hardship. They also have to sign that they weren't convicted of fraud in the last 10 years and agree to a background check and must attest that they didn't knowingly or willingly falsely submit information to obtain their existing mortgage. And they have to agree that there's going to be punishments, fines, imprisonment if the statements they're making here in the application are false. So this loan is an FHA loan and will require mortgage insurance. And although the interest might be much lower and principal is much lower, they also will have to pay 1.5% for the mortgage insurance premium. So that will add to the overall rate. If you start out with 4.5% interest, add 1.5%, you've got a 6% interest. But of course, the amount of your principal is going to be less, so your total amount should really end up being less. But it is something to consider and explore to make sure that that's the best option for you. Of course, you as the homeowner have to make this payment in a timely manner, and the lender sponsoring it is oftentimes putting people on trial modifications with a similar structure to test the waters and make sure that you as the homeowner can keep to that payment schedule. Subordinate lien holders may choose to share future appreciation, and if they do, they get a certificate evidencing their obligation backed by HUD, or they might take an initial lesser payout of cents on the dollar, $1,000 to $3,000. Then later, once the home is sold, the primary lenders are paid back to the full amount of the interest on the loan and their interest in it. And then the secondary lien holders are paid in sequence until all prior lien holders are satisfied or the amount of available appreciation is exhausted. Then after this, if there's available appreciation, then those funds will go back to FHA. And so that's really the program in a nutshell. I'm going to be continuing this series. Keep an eye out for more in the Foreclosure Freedom Network series. Thank you.